Hi, this is Joseph. It is Monday, it's March 1st, and I wanted to make a quick video here just to share some insight on what kind of trading system I'm using. So very often on days like this, I'll get some emails or I'll get some private messages from subscribers or some people that are also considering using the service, and they'll ask me the question, how many trades have I had today? And sometimes they'll tell me, these messages that I get, the sender, they'll tell me that they're actually watching perhaps another service or another company, another trader, somebody who's offering services that are very similar to mine, and they're sort of watching them on this particular day, where it looks price action looks similar to what we're looking at. We're looking at a relatively tight, small range of consolidation here on the pound. This is a 1 hour time frame, so this will give you some perspective. I mean, this is the start of the new week right here. This is the close on Friday, and we're still trading inside of this range of consolidation. So what happens is on days like this, and I refer to this as sort of a typical Monday. It isn't always. I mean, it's not guaranteed that every Monday is going to be like this, but when Mondays look like this, I'm well aware of what's going on, and I just stay out of the markets. And I want to show you a couple of things that I use to also confirm that I should stay out of the market and I shouldn't trade, or at least, for example, put on a trade on this particular pair. And I'll show you what I'm using to figure that out, to determine whether or not there's enough volatility, participation, volume, momentum to actually consider getting into a trade. Because in order to profit, price has to move. It's got to go somewhere. And one of the mistakes that I made when I first started trading, and this goes all the way back to 2000, to late 2000, early 2001, I was just trading candlestick patterns. So inside of ranges of consolidation like this, I would execute trades inside of consolidation, even though I really wasn't aware. Again, this goes back to the beginning of my trading career when I didn't have enough experience, I didn't have enough knowledge, and I was just learning some basic candlestick patterns, thinking that that was going to be enough. So I would execute based on bullish or bearish engulfing candles, evening stars, morning stars, all of that inside of these trading ranges. And sometimes if the 1 hour chart looked like this and it was still inside a consolidation, I would go to a 5-minute chart hoping that it would give me some kind of an opportunity to get a little scalping trade. And in the beginning of your trading career, you're going to be excited, right? You want to take as many trades as you possibly can, but that's not how to profit consistently. You want to take as many trades as you possibly can according to a robust trading system that has been proven, that you completely understand and you're very comfortable with, and it is who you are. It is how you trade. That trading system is, it represents everything that you know up to that point and how you like to trade. So by going to a smaller time frame on a day like this isn't necessarily going to help you. You're still going to see some opportunities, let's say some candlestick patterns, but ultimately they're not always going to go somewhere. Sometimes, and we've all done this, I used to do this all the time, I would see a bullish, let's say, engulfing candle down here at support, and I would buy. And I would think immediately, well, it's got to go somewhere, right? It's going to go to the other side of the consolidation, or maybe a more recent high, something to that effect. There was something to justify, in my mind, why price would move. But again, on days like today, that doesn't guarantee anything. Just because you get a candlestick pattern inside a consolidation, that doesn't guarantee that it's going to go someplace. So how could you determine, how could you figure out if it's going to be one of those days where it's going to move and there's going to be a lot of momentum and volume behind it, or is it going to be one of those days where it's just going to continue to go sideways no matter how many trade signals you get inside of consolidation, right? Again, this comes back to understanding and knowing when to stay out. If you didn't understand how to read and to detect that constant battle between supply and demand inside a consolidation along with volume, it's going to be difficult for you to figure out if price is likely to stay inside a consolidation or if it's going to break out. So on a day like today, I can see what's going on with volume. I also do an exercise that I call counting the waves. I teach how to do this in my trading course. So I'm counting the waves and I'm noticing, for example, this little area right here, we would refer to this as an upthrust. And it's an upthrust that sort of fails and it comes right back down inside a consolidation. Again, here you can see that's the close on Friday. And then it makes the attempt again to start breaking out above the highs, the initial resistance level that we had set in place here. But it starts to sort of test this area just before the close on Friday, another level of resistance. And this is where it gets a little bit confusing because there's multiple levels of resistance, and this is where it gets difficult for people to figure out whether or not this is actually going to create, let's say, this resistance here. If we see a candle that closes above that resistance, could that lead to a breakout? Well, it could. But again, if you're counting the waves and you're watching volume and you're aware of this consolidation phase and you can read again, that battle between supply and demand without the use of any other indicators other than volume, if you can do that successfully, you can determine that it's likely to continue to go sideways like this and it's not ready for a breakout. But there's another method that I use that helps me confirm this, and this is where I'm going. So this is my point and figure chart. Now, I've been using point and figure chart for many years, and when I started using point and figure, it completely changed my trading, and in a good way. And what you're looking at is a point and figure chart that is not constructed based on time. So in the previous chart here, we're looking at a 1 hour bar chart. So every hour, we're going to see the end of 1 hour and the beginning of a new one, right? At the top of every hour, we're always going to see a new candle open. And this continues on, right? There's nothing you can do about changing this unless you change the time frame that you're actually looking at. But when we start looking at a point and figure chart, it is not constructed based on time. It's constructed based on the amount of change or the volatility and the action that's actually taking place here. So there's got to be some kind of significant change based on the way I create and construct this chart that would cause either another X in an up column or a 0 in a down column. Until then, unless there's some kind of enough momentum and there's some kind of change, excuse me, in the volatility here, price is going to continue to move around. I'm going to see these columns continue to move around inside of this range of consolidation. So when I use point and figure, it's going to provide me with a very, very clear level of support and resistance. And there's no mistaking when price is ready to break out. So for example, you can see here last week, there was a breakout to the downside. It was a range of consolidation. And when it finally starts to break out of that support low and that range of consolidation, that's when I get in. So when I get a signal on my point and figure, that's usually when there's enough momentum and enough participation at that time where it's likely to continue to move to the target. So I'm not in the trade for very long. As opposed to a day like this where, let's say I saw a little breakout here and I wasn't capable and didn't know how to read everything I've explained up to this point, using volume, counting the waves, tracking smart money, all of that. If I didn't know how to do that, it'd be tempting to go long when you see a breakout above resistance. And a lot of people will do that. They'll draw short-term trend lines, and when a trend line breaks, they immediately get in. And sometimes it works, but sometimes it does not. And on a day like today, it isn't all that likely to work out. You can see what's happening. It's still inside of this same range of consolidation that was put in place prior to the market closed on Friday. So that's a pretty frustrating situation to be in, because when you have to make a decision about which trade you should take based on all of the different currency pairs or markets that you're trading for the day, you have to decide where to allocate your capital. And if you put your capital, if you put all of the money that you would normally put into one trade and you put it on this trade, let's say on the pound dollar, if you can determine that it's likely to stay inside a consolidation, then you may consider passing on that signal because you know that it's likely to stay inside a consolidation, and then you would look for another trade or another currency or another market, another opportunity where, again, you could see something that would set up similar to what we see over here on the top left. There was a range of consolidation, and when there's enough momentum and participation, that's when the point and figure starts to generate more zeros in a downtrend or X's in an uptrend, and it gives me an entry. Not only that, not only does it give me a very clear entry, so I'm not messing around inside a consolidation. I stay out of it because I can see it here on the point and figure. I know it's not ready to break out just yet. It's going to look like this, and if it breaks out to the upside, it's going to look like this area right up here at the top left where it created this downtrend, just in the opposite direction. So again, there's no change in volatility yet, and there's no reason for me to consider getting into a trade like this. But there may be a currency pair or another market, let's say oil, gold, silver, something like that, or even some of the indices that I could trade, where it's actually breaking out. So that gives me an opportunity to put my money into another market or another trade that's likely to pay me a lot quicker, instead of getting into a trade here and tying up all of my capital and then it goes sideways. I used to do that all the time. I couldn't figure out how to stop that. I would see, what I thought was a good trade entry when I first started trading. I'd get in thinking this is great, now I'm going to make money, and then it would just go sideways, and by the end of the day I'm still in the trade babysitting it, and it's just going sideways. So you have to learn how to read this. If you don't know how to read this, point and figure is going to help you clear it up. Now, one of the things you could do is use the trade copier. Using the trade copier will allow me to execute those trades for you. You don't have to worry about it, and eventually you can learn how to use and apply these methods yourself, but the trade copier is basically me executing those trades for you. I open them, close them, and I pick, based on everything that I've shared with you up to this point, I pick the better trade opportunities. There's going to be every once in a while some days where it's difficult to read, right? Sometimes you might get into a trade and you're thinking you're doing the right thing, and it could, for whatever reason, reverse and go back in. Every once in a while that will happen, but it doesn't usually happen. And again, point and figure helps me clear all of this up, not only getting a precise entry, but it also, based on the data and the way the point and figure is constructed, this chart, it also gives me an opportunity to measure a count, which is where is price likely to go. When it finally breaks out of this range, let's say it breaks out to the upside, how far is it going to go? Because that's another challenging issue that a lot of inexperienced traders face. I used to make the same mistake when I first started trading. I'd get into a trade and I was up 15, 16, maybe 20 points, and I'd think, well, this is great. Maybe I could get 40, maybe I could get 60. And if you're thinking that way, in those terms, that you're just hoping to get more, and there's nothing to justify, you can't figure out why it would move, then you're likely to hold on to a trade and give back all your profits. I would do that all the time. I would hold on too long. I didn't know where to take profits, and I'd end up giving back whatever profits I had. With point and figure, it gives me the opportunity to measure a count telling me exactly where price is likely to stop. And if you watch some of my videos, you can see over and over again when I'm using the point and figure chart, it is very, very accurate. And this is a method of trading. This is one way of constructing a chart that has been in existence for well over 100 years. Now, they say that candlesticks have been around for a long, long time too, a few hundred years. But point and figure has been so accurate, it's always giving me a very precise, not only entry, but a take profit level. So these are some of the tools that I'm using when I'm trading with the trade copier.